Have you started saving for your retirement? Have you got a pension fund? What is a pension fund anyway? How much should you save monthly for your retirement? When we return, we'll look at ways that will get you thinking about your retirement and how you can start saving or managing your pension fund. Hello everyone, my name is JP of JP Financial and Accounting, Everyday Finance Made Simple. In this channel, we try to train, to coach and equip you in relevant money management skills. But above all this, we try to glean as much wisdom as possible from scripture. To support this channel, please do like this video if you find it interesting. And also, please put your comments below and ask any questions that you want me to answer. And if you are new to the channel, please do subscribe. This will help us a lot to grow the channel because of the way the YouTube algorithm works. Today, we are talking pensions or saving for your retirement. This is one of those subjects where it is useful to start saving early. So if you have any young people around you, please share this video with them and get them thinking about their retirement early, because the longer you are in the stock market or in investing, the greater the return. So starting early is of vital importance. Previously, I've done 3 separate videos on investing in the stock market. Those videos are relevant to this discussion. If you have not seen them, I would advise you to go and check them out because they are very applicable when we are talking about pensions. In other words, a pension is simple an investment for the future. I think it will be best to start by defining a pension, what a pension is, and some of the terms that you may have heard being used when people talk about pensions or pension schemes. In the US, you'll hear terms like the 401k, but in Britain, we tend to use the word pension fund or retirement fund. The first term that I would like to define is a defined benefit pension fund, or a DB, as it is sometimes referred to. In some instances, you'll hear people talking about a final salary pension. All these refer to a defined benefit fund. A defined benefit pension scheme is one where the amount you are paid is based on how many years you have worked for your employer and the salary that you have earned. That's why it is sometimes referred to as the final salary pension. In other words, it's dependent on your final salary and the number of years that you have worked for that particular employer. But I must add that defined benefits pensions are very few now in the marketplace. Very few employers offer defined benefit salary schemes because they tended to be very expensive for the employers and they brought a lot of uncertainty. So they are a dying breed, especially in the private sector. In the public sector, you may still get defined benefit pension schemes. But for most of us who are in the private sector, this is a dying breed. The next term that I would like to define is what is called a defined contribution pension, or a DC. With a defined benefit pension scheme, you build a pot of money, and then you use that pot of money that you have built as your retirement income. Unlike the defined benefit scheme, it does not guarantee a specific income in retirement. The income that you'll get from a defined contribution scheme depends on a number of factors, including how much you have paid in, how the fund has performed in the stock market, if it is invested in the stock market, or how it has performed in commodities or wherever it's been invested. And of course, the choices that you make at retirement. We'll look at these briefly. The third pension scheme that I would like to look at is what we generally refer to as personal pension. A personal pension is a pension fund that you create yourself. This is especially useful to people where their employers does not offer such a fund, or self-employed people. And strictly speaking, a personal pension is a defined contribution pension. The difference is you choose the provider and make your own arrangements how you pay funds into that fund. The last term that I would like to define is what is known as a SIPP, S-I-P-P, which stands for Self-Invested Personal Pension. Again, this is a defined contribution pension fund. The book definition for a SIPP is it is a pension wrapper that holds investments until you retire and start to withdraw a retirement income. The main difference between a SIPP and other personal pensions is that you have more flexibility in how you invest the funds. In other words, you have the control. You choose where to invest the money. Generally speaking, most pension fund managers are conservative. They invest the money in what can be termed safe markets. But if you want your pension fund to grow quicker, in a SIPP, you've got the choice. You can, for example, choose to invest it in developing markets in Asia, for example, where the return and the growth is more higher than the stable markets that you'll find in the UK, for example. Or you can choose to invest in the US, where the market is much larger than the UK. So with a SIPP or a self-invested personal pension, you choose where the funds are invested. Now that we've got those definitions out of the way, let us look at a number of things that you might think of when you are investing in a pension or when you are investing for retirement. The first thing that you need to think about is how much you want to earn in retirement. As a general rule, most funds or pension funds, they will say aim to earn between 50 and 70% of your current salary. Why is this important? It is important because even in retirement, you still have bills to pay. For most people, bills are greatly reduced when you retire. For example, normally, many people, by the time they retire, they don't have a mortgage. Many people, by the time they retire, they do not have to pay for a daily commute to work, for example. By the time you retire, you have less expenses because for many people, the children have left home, so you don't have children. Children have been through university or college, so you don't have those expenses. So normally, your bills or your going out are much less than when you are in employment. So for many people, 50 to 70% of their income while they are working is sufficient to give them a comfortable retirement. But you can choose to earn 100% of what you are currently earning, or you can choose to earn 25%, depends on how you want to live out your retirement, how you plan for your retirement. If you want, for example, to spend your retirement in overseas holidays, you might even need much more than the 100%. So that means you need to save much more now for your retirement. The second thing to consider when you are building a pension pot is how you want to withdraw that money at the end when you come to retirement. There are generally two ways of drawing on your pension. The first one is what is called the drawdown method. In other words, in that method, you decide how much you want to draw down from your pension on an annual basis or monthly basis, depending on how you want to do it. And one thing also to remember is that your pension is taxable when you retire. We'll look at that briefly later on as we continue in this discussion. The other method of drawing down on your pension is what is called the annuity method or buying an annuity. The main advantage of an annuity is that it guarantees you income for the rest of your life. You see, with the drawdown method, let's say you've got £1 million in your pension pot. You can decide, I want to draw £100,000 a year. But that means after 10 years, it will run out. If you live for longer than 10 years after retirement, that means for the rest of your life, you will not have any pension to draw from. Whereas if you purchase an annuity, it guarantees you income for the rest of your life. But of course, with that advantage comes a disadvantage that what you receive from an annuity might be much less than what you'll get if you decided to draw down on your pension. To summarize this part, the amount that you get in retirement is dependent on a number of factors. Number one, how long you save for. Number two, how much you put in your pension pot. Number three, the choices you make when you retire. Do you want to draw down or you want to buy an annuity? Number four, how much you take as a lump sum. Yes, when you have a pension, you are allowed to take up to 25% as a lump sum from your fund. It is also dependent on how where your investment has performed in the stock market or wherever you've invested the funds. Another factor is dependent on how much your employer pays into your pension fund. That is if you have a workplace pension. Also, the annuity rates at the time you retire will determine greatly how much you get. And finally, it will depend on what charges have been taken from your pot by your pension provider. If you look at my investment videos, you'll see I talk there about the importance of watching out for charges. If you ask fund managers to manage your pension pot, they will charge you for that. And sometimes those charges can be significant and they can greatly reduce your pension pot. The next question I would like to answer that many people have asked me in the past, how much should I be putting away on a monthly basis for my pension? Can I shock you first before answering this question? Some financial advisors say that you should take your age and half it, and that's the percentage that you need to be saving away. For example, let's say you are 30. If you are 30, half 30 is 15. That means you should save 15% of your income for your pension. If you are 50, you half that, 25. That means you should save 25% of your income as your pension. But of course, this is dependent on many factors that we've already discussed above. And you will have already figured out that that method of taking your age and halving it is pretty much crude, it's rough. If you want a more precise way of working out your pension, if you go to the websites of many pension providers or insurance companies, you will find that they have got what they call a pension calculator. Let us just look at one such example of a pension calculator on how you can work out how much pension you can save. If you Google pension calculator, you'll see there are many websites that offer pension calculators. Look at this one from the Pension Bee, this one from Vanguard, there are many to choose from. But as an example, let's choose this one from Age UK. So let's see how it works. Start calculator. First thing you can do, enter your age. So you were born 1st January, let's say 1975, for example. Choose your gender. When do you want to retire? Let's say you want to retire at 67. Click next. As for your income at the moment, let's say your income is £55,000 a year. Click next. Do you have money in your pension pots at the moment? Let's say you've got one pot and you've got £100,000 in your pot, then you can add more pots if you've got more than one pot. Okay, and then tell us how much you are contributing currently to your pension. Let's say you are contributing £250 a month, and your employer is also contributing £250 a month. Click next. Do you have any defined benefit pension? As I said, this is a dying breed, so few people will have this, but if you have a defined pension, you can enter it there and your retirement age. Let's assume you don't have one and you don't have any other income. So this is the information that we entered. Current salary, 55,000. Target income, which is 50% of 55,000, which is £27,500. Your retirement age is 67. So this tells you that with that contribution, your state pension at 67 will be £9,110. We don't have any defined benefit income and we don't have any income. And then from our pension pot, we'll get £11,201 a year. So if you add these two, it gives you an estimated income of £20,311. And remember, we said our target was 50% of our current income, which is £27,500. Therefore, we have a shortfall of £7,000. So now you can start thinking about, what do I do with that shortfall? Do I lower my target income, or do I increase my contributions, or do I invest more aggressively? These are the decisions that you can make after using the calculator. And please, if you don't understand, you can seek professional advice here. So this is how the pension calculator works. Some work slightly different, but all of them, they can help you to plan for your pension, to look at how much you're saving at the moment, how much you need to save to get your target income, so forth and so on. The next question that I would like to answer, which I've been asked by many people previously, is which is the best way of saving for a pension? Is it using an ISA or using a pension fund? I think the best way to answer this question is to look at the advantages and disadvantages of each, and you can choose which one works best for you. The first consideration that we need to look at is what is known as tax relief. When you decide to put funds in a pension fund, the government allows you to save those funds tax-free. That is 100% of those funds tax-free up to a limit of £40,000 a year. And for many of us, £40,000 is a lot of money to save in 1 year. So for many people, 100% of their pension savings are tax-free. The second thing to consider is what is known as tax on withdrawal. In other words, when you eventually decide to withdraw your funds, how much of the funds are taxable? With an ISA, 100% of the savings are tax-free. Whereas with a pension, 25% can be withdrawn tax-free, but the rest is taxable at the rates of income tax at the time you withdraw the funds. The third consideration that you need to look at is what is known as the maximum allowance. With an ISA, you are allowed to put away £20,000 a year, and with a pension, there is no such limitation, so you can put in as much as possible. But of course, as we said, anything over £40,000 that you put away is taxable. The fourth and final consideration that you need to look at is what is known as accessibility. Can I access the funds when I need them? With an ISA, you can access them at any time. If you decide you want the money tomorrow, you can withdraw it tomorrow. Whereas with a pension, you can't withdraw the funds until you reach the age 55. So if you think you're going to need the funds before age 55, you are better off using an ISA to save for your retirement. So these are the advantages and the disadvantages of each. So depending on your unique situation, you choose the best option for yourself. Having said this, a combination of both, that is an ISA and a pension scheme, could be the best way for saving for your retirement because both have different tax advantages. Moving on, I've compiled a list of do's and don'ts. But remember, these are not set in stone. You can choose the ones that you like and discard the ones that you don't like, depending on your unique circumstances. The first do I have is please do set goals. Goals like, how much should I be saving away for my retirement? How much income do I expect to get when I retire? When do I expect to retire? Look at these early. The earlier you look at them, the better it is for you. The second do that I have is please do check what help you can get. Please do check what help you can get. This is very important. We'll look at it later when we go to our verse of the day. The third do I have is do start early. Start saving for your retirement now, especially for young people. The earlier you start, the better it is for you. But even if you are much older, starting late is better than not starting at all. The next do I have is do more than is necessary. In other words, what I'm saying is don't save the minimum required. Save more if you can. If you can afford to save more, save more. The next do that I have is do check that your workplace pension is using your correct retirement age. The next do I have is do think about who will inherit your pension. Make sure that your pension provider has the correct details of your next of kin. And do consider consolidating your pensions. In the past, people used to work for one employer for all of their lives, 40, 50 years. But research shows that now, on average, people change job at least 6 times during their working life. And so if you create different pension pots with each different employer, you end up not knowing what pensions you have. So it is important that you try to consolidate your pensions. Earlier on, we spoke about a SIPP. This is one way you can consolidate your pensions and manage them. And then also, I have a few don'ts. The first don't is don't be too cautious in your investment choice. This is particularly applicable to younger people. The younger you are, the more aggressive you can be in investing in your pension. The next don't I have is please do not opt out of your company or employer's pension, because opting out is effectively taking a salary cut. Remember, many employers are willing to match whatever contributions you put towards your retirement. If you put 5% of your salary, the employer generally is willing to put another 5%. Some employers are even willing to put 7.5%, 10%, even more. The next don't, earlier I did say do save more than is necessary, but the next don't is do not save too much that you live a pauper's life now. So do not make yourself broke because you're saving for your pension. The next don't that I have is don't over-rely on your state pension. Yes, the state will pay you a pension when you retire if you have been contributing your national insurance contributions. But don't over-rely on that, because as I've shown you earlier on, it's at the moment it's currently £172 a week. That's not a lot of money. The next don't is don't be tempted to withdraw from your pension fund just to put it in a bank account. I do another video where I talk about savings accounts, and you'll realize that saving account interest rates at the moment are really poor. So don't be tempted to withdraw funds from your pension fund just to place them in a savings account. And finally, please do not touch your pension unless it is necessary. Don't be tempted to withdraw from your pension to buy that nice car if it's not necessary. Okay, finally, let us go to our verse of the day. Our verse of the day today comes from Proverbs chapter 15 and verse 22. Proverbs 15 verse 22. It reads, "Without counsel, plans go awry, but in the multitude of counselors, they are established." An easier version of the Bible reads, "Without counsel, plans fail, but with many advisors, they succeed." I particularly chose this verse because I realize how complicated the subject of pensions and investments is. Without expertise, it's very difficult to figure out what to do. We have wise counsel from the Bible here that we need to get advice from many different people. You know what they say in medicine, get a second opinion. It is wise when you are talking of pensions to get a second, third, fourth opinion. The Bible uses the word a multitude. In other words, many counselors. I'm not suggesting here that you go to many different people and pay many different advisors for counsel, but you can do some research yourself. We live in the internet world. You can go in there and read from many different people, many different sources. You can look at different YouTube videos like this one and try and understand the different perspectives and the different things that you need to think about when you're saving for your retirement. And this verse is not just applicable when we are talking about retirement, it's applicable in many aspects of life. Yes, it is applicable when we're talking about saving for your pension, but it is equally applicable when you are choosing a university place, for example, for those young people that are going to be going to university. It is applicable when you're choosing a spouse. It is applicable when you are thinking about what job or what career to choose. It is applicable in all aspects of our life. Seek counsel. Where there are many advisors, it means you can look at the same thing from different angles and come to the best conclusion. And of course, I do not mean that you take every single word of advice that you hear. I do not mean that when you read this article and discover what it says, you change your plan. You read another one, you change your plan. No, I don't suggest that. What I'm suggesting is that you get many different perspectives and then make up your mind. The verse again, "Without counsel, plans go awry, but in the multitude of counselors, they are established." Without counsel, they will fail. But when you get many advisors, it means your plans are more likely to succeed. I hope this video has been helpful. I hope you have enjoyed it. Please do like the video. And also please share it with your family, friends, acquaintances. And also, If you have any questions, please comment. And even if you don't have any specific questions, I do appreciate your feedback in the comments below. If you are new to the channel, please do subscribe, hit that notification bell so that you are notified when we post new content. And also, it does help the channel to grow because of the way the YouTube algorithm works. Thank you for your support. See you in the next video. God bless.